Welcome back. Taking the conversation on the markets forward now with Sahil Shah, who is the CIO at Equirus Asset Management, who is joining in. Sahil, good morning. Thank you for joining in. Before we get to your top holdings, and there are some interesting names there, we would like to talk about those in greater detail. We are on the cusp of earnings season starting up. I'd like to talk firstly about the consumption bit, right? There has been conflicting reports or contradictory reports, if you could call it that. There's one brokerage citing almost a $40 billion consumption boom over the next 2 years, but the macro data on ground seems to suggest otherwise. Where in the consumption basket are you placed, be it discretionary or staples? I see your discretionary is one of your largest holdings. Where within the consumer discretionary space are you bullish on?
So good morning, and thank you for having me here. So we are very much positioned on the discretionary side of on the consumption side, and more importantly, we believe that a lot of companies which have done consistently well on the consumption side, they are trading at high valuations. So what we are more positive on is on the turnarounds in the consumption space, as well as some of the names on the jewelry side, where we believe that the formalization of on the jewelry side is going to continue over a longer period of time. Maybe there is a 6 months to 1 year of subdued growth that might turn up. But from a 3 to 5 year perspective, I think jewelry and some of the consumer discretionary names where we see a lot of margin upside potential should do well. And that is where we are finding a lot of value.
Hi, Sahil, right. So you're finding value coming in on the jewelry side is what you're talking about. And I see in your holdings also you do have Thangamalai jewelry, but are there any other options that you would look at? What is the strategy here in terms of overall? Other than jewelry, are there anything like hotels or luxury side that is something that you would watch out for, given that's also a discretionary bet?
Yes. So, I mean, we are not, we don't have anything on the hotels or on the other names that you mentioned. More importantly, a lot of our weight is also inclined towards consumer discretionary side, where we are seeing significant margin expansion in some of the names, whether it is some bedding company or some of the consumer durable names. So we believe that the top line growth, X of jewelry and X of certain segments within the consumer discretionary space will continue to be around 10 to 13 odd %. But what will really drive the earnings growth will be the margin recovery in some of the names that we have identified.
Interestingly, Sahil, Thangamayil in your holdings were in a field where you have names like Titan, Kalyan Jewelers, Senco, and a lot of others. What drives your conviction on a name like Thangamayil? Is it just because of the smaller size and it has the scope to grow larger? What is your rationale on this?
So I think Thangamayil has been present in very micro markets, and now they are going into a very large market, which is the Chennai region, which itself is a very, very big market compared to the size of the company that it is. And as the company is able to successfully expand into those markets and they go into more southern markets, I believe that there is a lot of scope of growth, at least in the southern market itself, where Thangamayil Jewelry is a good brand name. So that's right. What is driving our conviction on Thangamayil Jewelers.
Sure. Sahil, I just want to understand your thought. Overall, now in the markets going forward, do you believe the broader end of the markets, right, the small cap or the mid cap will see a better performance versus large cap, even in terms of earnings that you're watching out for? Because last 6 months, I think small cap is down 1%, while mid cap is up 2% and Nifty is up 6%. This is the 6 month that I'm looking at. So you are expecting outperformance now from the broader end of the market.
Yeah, so I think, so what has happened is that post-COVID, the earnings growth of small and mid caps has been far superior as compared to the large caps. And that also drove the performance of the small and mid caps from post-COVID levels to almost in 2024. Now in FY25, what happened was that there was a convergence in the earnings growth of large caps as well as small and mid caps. And both grew by in the mid single digits. Now, as far as small cap is concerned, people typically don't invest in small cap for a mid single digit kind of growth. And hence, the small cap performance in FY25 suffered. Going forward, what we are expecting is that small caps will start outperforming the large caps, as it has happened post-COVID, and if you look at even longer-term history of 10, 15 years, small and mid-cap earnings typically outperform large caps by a good margin. And I think that thing will resume in the next 2 years. And as that happens, I think small cap outperformance should again come back.
There are a couple of other names in your list, Sahil. Kolte Patil is one of them. It's just undergoing a takeover process right now. IFB is the other one, two completely different. Now, a lot of analysts, experts believe that real estate is currently in the midpoint of its upcycle. Do you believe that Kolte Patil also does that carry the same rationale as Thangamile does? Because Kolte Patil too is present in a lot of micro markets and is moving into larger ones now. And what about IFB? Because a lot of these durable manufacturers have spoken of challenges on ground currently, especially because how the summer turned out to be, which is their peak season. Tell us your rationale for these two.
So, as far as real estate cycle is concerned, there are pockets, there are regions where if we speak to the management, they themselves are saying that 60-70% of the buying that is happening is not because of the own consumption, but it is more driven by investments. And whenever that has happened, we have seen that there are real estate bubbles that have been created. Now, this is more region specific, and this is not happening across India. Where the stock specifically you mentioned is present into is more into Pune markets, and now increasingly getting into the MMR region, which is the Mumbai region. So that is a reason why we are quite comfortable. And with the new private equity entering in, more aggression is what we are expecting in terms of pre-sales growth, which was lacking for this company over the last 2 to 3 years. Now
Yeah, please go on.
Now coming to the other consumer durable name that you mentioned, as I mentioned that in some of the consumer durable or consumer discretionary names, we are expecting a good amount of margin recovery to happen. The companies have demonstrated some bit of margin recovery in the last 1 year, but a large part of margin recovery, if it happens over the next 2 years, then there is a good valuation re-rating potential that these stocks can have.
Okay, Sahil, thank you so much, for joining in with us on the show and giving us your time, helping us understand the outlook for the markets as well as the sectors and stocks that you're looking at. But on that note, we're actually going to slip into a very short break. But remember to tune into all new CNBC TV18 Prime, bringing you insights from policymakers, business leaders and economists shaping both the world and India's future. CNBC TV18 Prime decodes global shifts and their impact on Indian businesses, giving you unparalleled insights. Tune into CNBC TV18 Prime at 12 noon for the Global Reset, at 1 p.m. for the Big C, and Global Lens at 8:30 p.m.